This is an easy one, but the questions that you come from here are a little tricky. So we want to concentrate a lot on the questions. This is just for your for a situation. Okay, let's say if I want you guys to build up the journal entries. Okay, I want you guys to build up these journal entries. And the first half is when the economic event happens first, cash flows later. Okay. And the next kind of a scenario is when the cash flow happens first and the economic event happens later. And allow me some time, I will explain this to you. Okay. And let's talk from the revenue perspective and let's talk from the expense perspective. You don't have to write it, I'll give it to you. The only reason when I do it is it makes you think. If I give you everything on the platter, you don't think, right? So give me an example of a revenue item where the P&L credit happens first and money flows later. The P&L credit happens first and the money flows later. Yes, guys? Give me an example of a scenario. I created my receivable first. So what we are doing is we are actually first booking. So this is the revenue earnings process being complete. I will first book a right to receive. Now this is first balance sheet. This is first P&L and it will hit my balance sheet. And then later on, this is only my balance sheet item. Yes or no? Yeah. That means the year when I have done the work, I will go and hit my P&L immediately. And if I have not received the money, I will create a receivable in my books. Next year when I receive it, I'm not going to go and touch my P&L because my earnings process was complete last year itself. So I can't put anything in the P&L this year. Next year, whenever something is flowing in and out related to last year, it will only have a balance sheet impact. It will not have a P&L impact, right? Great. Give me an example of an expense which happens first, but it is paid later. Okay, take common examples. Take the ones which will all salary, right? Salary is an expense which is going to hit first, right? And then I end up paying salary later, right? So what is a journal entry when I accrue the expense? Salary will be debit, which is a P&L, outstanding salaries or accrued salaries. What is this? What kind of an account is this? Current liability account, which will increase my liability. And when I pay the salaries, what would happen? So basically now the year when the salary has hit, I have already debited my P&L and close it to the balance sheet. Next year when the payment happens, I am not going to touch the P&L. I'm going to just reverse that liability and I'm going to pay it in the bank. That means whenever the economic event happens, that's the year, whether it's a credit or a debit, where your P&L will be hit. Any subsequent year, when you have the cash moving in or out, that year we don't go and touch the P&L again. Whatever entries we make, they only hit the balance sheet. And that is what is meant by the matching concept and the accrual concept. Because the year when you hit the revenue, the same year you have to hit all the expenses. And any year thereafter, you cannot go and touch the P&L. After that, whatever happens to the balance sheet, not to the P&L. Okay. Now, what happens if I'm talking about the cash flow happening first, but the economic event happening later? What is the example for revenue? Advance receiving against sales. So, always when you think of example, you have to think of an industry where this is always happening first. Real estate is one very good example. Even guys, rent, whenever rental income comes in, it is always pre-received. Okay, we always pay in advance and then the rent happens. Subscriptions, whenever you apply for a magazine or any subscription, the subscription comes first and then the work is done. Now, in all those cases, what is a journal entry? I receive my debit and I create a liability account, which may be an advance account or which may be something called pre-received subscription. Let's say we have something like a subscription that you're receiving in advance. The idea is you create a liability. So this is only balance sheet impact, right? And then later on, when you have to book the sale, what will be the entry? When you have finished the earnings process, what will be the journal entry? Very good. That means your advance account will get debited, and now your P&L income will be hit. That means your sales account will be hit. Yes. That means whenever we have first the cash flow and then the economic activity, when the cash flow happens, the earnings process has not been complete. You cannot go and touch your P&L. You're only going to impact your balance sheet. And then when your earnings process gets complete, you're going to take it out of the balance sheet and you have to book it as a P&L credit. When you receive the money, since the earnings process is not complete, you cannot go and hit the P&L. You will have to create a liability. Imagine if Harvard Business Review, which is a yearly subscription, if that receives all your money, and tomorrow if the business shuts down, God forbid, if it shuts down, immediately it is a liability for you to pay back all that money. Yes. Yeah, to pay back all of that money. So that is why you can't create a P&L credit. You can't hit your equity. You have to make a liability out of that figure. The last quadrant, guys, when you pay for the expense first and then you book the expense later. Give me the practical example, guys, okay? That means what we are doing when I'm paying that money, which we did in the last example that we just did. When we are paying that money, I will create a current asset account. Why? Because the expense has not been incurred. Yes, rent, insurance, these are some very common examples where the money flows out first, but the expense is incurred later, generally with the passage of time. So in all those cases, when the money is paid first, you debit your asset account, which is current asset, and you pay away the cash. And then later on, when the economic activity happens, in most cases, it is the time which is going by, then you reduce that asset and you seep it into your P&L account. So this becomes your P&L account. This is P&L debit. So initially only balance sheet impact, and then you take it out from the balance sheet and put it into your P&L account. Is everybody clear with this? Anybody, any questions? See, you should be able to write your journal entries. And I think the approach that we decided today, whereby you have your balance sheet, your P&L, and your accounting equation approach, that will always work. These are some very common accrual accounting concepts which will help us do everything else when we go along in our course. Okay? So this is exactly what we suggested when we said that when the economic event happens first and the cash flows later, you're going to debit the asset and you're going to credit the income. The P&L gets first and then the balance sheet impact happens, both for revenue and for expenses. But when the cash happens first, it is first the balance sheet impact and then you seep it out from the balance sheet and then you put it in the income statement. We are now kind of, we say that you build up the bottom and then you go up, but in finance we are going to do like this. We are going to have an inverted funnel approach. Everything should be equal to be able to be tied up here. Plus you need to understand the application of matching or the accrual concept and the going concern concept. If this is 100% clear in your mind, trust me, everything that we are going to put on this is going to funnel into this. So we are building this up. Then we will do the first layer where we are going to talk about just the concept, like what we did right now, right? What is accrual concept? How you're going to use it? And then we are going to build up slowly, slowly. So this will be level 1. We are going to just talk about basics, cash, assets, debtors, revenue recognition and stuff. And then in level 2, we are going to build it up with complex topics. How are you going to use the base and the level 1 to talk about taxes, to talk about derivatives, to talk about, let's say, leases, to talk about consolidation. The same concepts, the application would vary in different sets. So this is how we are going to talk about FAR in your real life. And everything that you do, if you can funnel it down to the basic accounting equation and the accrual concept, there's nothing else in FAR that can get more complicated than this. Is this clear, everybody? So if I ask you guys, what is the relationship between assets and cash? the asset flow and the cash flow. What is the relationship? What will be your answer, guys? What is the relationship between the asset flow and the cash flow? Very good. That means, can I say there is an inverse relationship between an asset flow and the cash flow? When the asset goes up, for instance, when I'm buying the asset, my cash comes down. When my asset comes down, for example, when I'm selling in my asset, cash goes up. Is everybody clear with this? Now, this is something, guys, there are certain topics which are very confusing. And even though you know the concepts really well, it is fairly difficult to arrive at the right answer first time with the concept. So, in certain places, like, when we're doing cash flows, I am going to give you shortcuts, which is derived from some basic fundamental concept. But if you know the shortcuts, every time you get the answer, it will be the correct answer. Understand that the asset and the cash flows are inversely proportional. That means when the asset goes up, the cash comes down. When the asset comes down, the cash goes up. How do you remember this? If you're confused, get confused, understand asset going up, I'm buying an asset. That means I'm paying, that means cash coming down. Asset going down, that means I'm selling the asset. That means cash is coming in. What is the relationship between liability flow and cash flow, guys? What is the relationship between liability flow and the cash flow? Yes, guys? Liability flow and the cash flow. What is the relationship between the flow of liability and cash? Hey, guys, is this clear? It's a direct relationship. When the liability goes up, for instance, when I'm borrowing the money or I'm injecting the equity, that means cash is also going up. And when the liability comes down, for example, I'm repaying a loan, then the cash comes down. In very simple language, assets are inversely related to cash, liabilities are directly related to cash flows. Can I say that, everybody? So that means change in cash is inversely proportional to change in assets. Cash going up, asset coming down, cash coming down, asset going up. And changing cash is directly proportional to change in liability. Cash going up, liability going up, cash coming, liability coming down. I want this to come to you like a reflex. You should not have to think about it. You should just know it. It's a reflex. Okay. Why are we talking about this? Because this is the area which is like a most dreaded area in accounting. People kind of get really confused in this when they start working. And okay, okay. Now I want you guys to try this sum out. Okay, what is this sum? They have given you an accrual basis accounting, something that you do while you're making your cash flows, right? I have been giving my accrual basis income, and now they're asking me cash flow statement. Okay, and now they're asking me to convert it into my cash flows. See, JJ Thompson's maintain accounting records on an accrual basis. In a particular year, the company decided to convert to cash basis accounting. So if I'm giving you an accrual income and I want you to convert, during this year, there was a net income. So last year, this was my net income. And I decided to change it into the cash basis, right? So I'm basically asking you to convert accrual basis net income to cash basis net income. I'm just going to convert net income to net income, but this is accrual basis and this is cash basis. That means I'm just taking my P&L statement, I'm converting it into my cash flow statement. Okay. So I'll quickly give this. There is a plus of 6677. There is another plus of 1271. there is a minus of 1327 and there is a plus of 1315. Okay, guys? How are you going to calculate the net income on cash basis from accrual net income? So see, think about it. I am not going to, so if I start doing it at an individual level, it may be really time consuming and I'll get confused somewhere in between. So what I'll do, I'll use the shortcuts. What does a shortcut ask me? What am I starting with? So first thing that you got to ask yourself is, what am I starting with? I am starting with my P&L net income of a positive 95,178. So imagine I've been given a balance sheet where there has been change in assets and liabilities, and I have been given my net income. And you have been asked to tell me, okay, if I think in terms of cash, tell me what has been my net income, but on cash basis rather than accrual basis. So what I will do, I will start with net income, which is given to me. And then I have to make changes on account of balance sheet movement. So my first item is accounts receivable. Okay, I want volunteers here, guys. Okay, we'll think through and we will get this. Okay, so accounts receivable, Lakshmi, unmute. Accounts receivable is what? Tell me, asset or a liability?
Asset.
So if the asset goes up, cash will?
Go down.
If the asset goes up, that means cash will come down. That means when I'm starting with a positive net income, if my cash is coming down, that means I'll have to bring it down.
Yes.
Yes or no?
Yes, ma'am.
If I bring it down, then I know that whatever I'll get is the cash that should be there with me. Yes or no?
Right.
Is this clear? So all you have to think about is it an asset item or a liability item? Is it going up? Is it coming down? If it's an asset going up, then I know that cash is to come down. Is this clear? So it's a liability account. What is happening to the liability throughout the year? That means when liability goes up, cash will also go up. At
Bank account.
1,
Yeah.
2, 7. Is this clear? So
Yes.
I start with net income. I kind of find out what account I'm talking about. If it's an asset account and the asset is going up, that means my cash will have to go down because asset and cash is inversely related. If it's a liability account going up, that means direct relationship, liability goes up, cash goes up. So I'm
Got it.
starting with the positive net income, it has to be a plus. Is this clear? See, I am not even cash flow statement. I don't want you to go and do thought wise. I don't want you to go and think, oh, accounts receivable. Okay, last year was spending. That means this year I would have got it. This will be minus. Again, this will be plus. I don't want you to do it individually. So there is a possibility that people start doing this, right? Last year was receivable. That means this year I would have received it, but now it is not there. So I will reduce this and then I will add. I don't want you to do this. I want you to do these kind of questions mechanically. And that is how you will save the time and you will get the right answer every single time. What am I starting with? I'm starting with a positive net income on the accrual basis. What has been the change? If it's an asset change, that means asset going up, cash coming down, minus. Liability going up, cash coming up, plus. Liability going down, cash coming down, minus. Asset going down, cash coming up, plus. So this is the first scenario where you're using the basic relationship between an asset and the cash flows and the liability and the cash flows to arrive at your cash basis accounting income from the accrual basis accounting income. Now let's just take it a notch different. Okay, so we are just trying to convert it a little bit different. So here so first thing before you even jump to the question, you need to ask yourself, what are we supposed to find out? What are you starting with? Okay, find out the net income on accrual basis that the company should report. So what I'm supposed to do, I'm supposed to find out my accrual income. From what? From my cash basis net income. Now I'm reversing the entire thing. So what I'm going to do, I'm going to start with cash basis and now I'm going to go to accrual basis. So how are you going to think? You're going to think like this. What I should have done, asset going up, cash should have come down. So ideally I should have reduced it. Now I will reverse it. Now I will add it back. So see how are we going to do this? So I'm starting where? I'm starting with cash basis net income. How much? 70,000 positive. Okay. What is happening with these quickly? The accounts payable is going down by 2, going something. Now here, this is just mechanical that I'm doing. This thing is going up by 100. This thing is going up by 300. This thing is going down by 800. Tell me what is the answer. When you do this, what is the answer? Quickly, guys. Somebody give me the answer. 71,200. Is this clear? Everybody, is this clear? Cash flow is a very important concept, and the only thing that we have to do is just do it mechanically. There are certain topics which, if you do mechanically, will give you instant result very fast and accurate. If you spend time in confusing it with the concept, you will end up spending more time and most possibly getting a wrong answer. For questions like this, where I'm using accrual to convert it to cash, I want you guys to think like this. See, we have a method. It's not that we don't have a method, but we have a quicker method which is more scientific. Now you know the logic. Why are we doing what we are doing, right? Anybody, any questions? Okay. Now we'll gear it up. Okay. Slow down. Questions like this are very, very dangerous. Okay. They're less numbers, but very conceptual. Can you give me the answer for this? See, now what they're saying, this is a new kind. Always understand what are you supposed to arrive at, what is being given to you. Debits to operating expenses totaled $100,000. What amount did Alberta pay? That means you have been given an accrual basis expense item. Okay? There was an expense item for which the P&L debit had hit to $100,000. They are asking you what is the cash outflow. Is this clear? They are starting with what is the cash outflow. Is this clear to everybody? Okay. So I'm starting with an outflow of $100,000. My prepaid expenses have gone up by 5,000 and my accrued liabilities have again gone up by $12,000. Prepaid expenses have gone up. What kind of an account is this? Asset. Asset is going up. So cash has to come down. That means this is a cash outflow. And you're already starting with an outflow. That means now this should be added. Have you understood the concept? I am starting with an outflow and there has to be a further outflow because I have paid further cash. Outflow and outflow. So general rule, it will be negative. But since it's already negative, I'm going to add it. Is this clear? Is this clear? This is an outflow and this is also an outflow. So I'm going to add it up. What about accrued liability, guys? My liability has gone up. So my cash should have also gone up. That means it's a cash inflow. If it's a cash inflow, that means from outflow, I have to reduce $12,000. So the answer becomes $93,000. Is this clear to everybody? So first step, what are we supposed to arrive at from what has been given to you? Step number 2. What am I starting at? Is it a cash in or a cash out? There's another way of doing it, guys. Okay. If you want to do it a little more mechanically, I'm starting with 100. The cash will be, an outflow will be negative and inflow will be positive. If you're comfortable doing this, then that is all. See, this will never change. The signs which are the original signs of -5 and +12 will not change. But if you keep this negative, it will remain okay. Is this clear? Okay. This is now, understand what we are trying to do. Okay. We are taking the expense of 35,000 on a cash basis. Now they have given me a cash outflow, and now they're trying to ask me what should be the P&L debit. Now they are asking me what should be the P&L debit. So I'm starting with a cash outflow of $35,000. And I know that my prepaid expenses have gone up by 5,000 and by 500, and my accrued expenses has gone down by 450. Is this clear to everybody? Okay. Now tell me, how am I going to go about it? So I'm converting from cash to accrual, and my prepaid has gone up and my outstanding has gone down. Okay. So the first entry, what is the answer? This is an expense, this is an inflow. That means I have to minus it. Have you understood this? Please understand what is happening. Asset liability going up, going down, relation with cash cannot change. Then you have to understand, is it a cash in and an out? And then compare it with what is the figure that you have with you. If it is an out and an in, you will minus. If it's an in and an in, you will add. If it's an out and an out, you will add. This is a liability account which is going down. That means general case cash could have come down. That means it is a cash outflow. Had it been accrual to cash, I would have made it an outflow. But this is cash to accrual. So I will have to treat it like an inflow. Is this clear? That means this is a cash in. Now what is it that I'm starting with? I'm starting with a cash out. So out and in have to be reversed. It cannot be same. So this is 450. Is this clear? So this is 34,250. That is the answer. Have you understood this or not? Is the thought process clear? What is happening? It's an asset. Asset coming down or going up? If it is asset going up, cash coming down. That means it's a cash outflow. But since it is not accrual to cash, it is cash to accrual, I will reverse it. It is a cash inflow. This is a cash in. I'm starting with the cash out. That means I have to reverse it. I have to reverse it. Or if you don't want to do it like this, okay, start like this. I know it is minus 35,000. See, if you have problems in understanding this approach, this is an easier approach. I know I'm starting with a minus 35. So it's an asset going out. That means cash has to come in. That is a cash in. That means in, I will add 500. Similarly, starting the negative flow, it's a liability coming down. Cash has to come down. Now I will reverse it. So it was a cash out. Now I will make it a cash in. If it's a cash in, then it has to be 450. So the answer will be the accrual basis cash expense. Have you understood this, guys? Is the approach clear? If you don't want to again confuse between in and out here, make this a constant sign, and this, whatever is happening, you just have to reverse it once depending on what you're doing, and that should be the sign now. So the answer is 34,250. Is this clear? Answer is 34,50. Yeah. Is the approach clear?